And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Good morning and welcome to the show. It is, of course, Tuesday. John Penn joining me this morning, as well as Brent Clanton, as always, driving the Length Challenge bus. So here we are. We're all hanging out together. Saw a really interesting article out this morning. Toughest jobs in America. Number one, firefighter. Right? That's a pretty tough job, right? I mean, there's a lot of downtime, but when you're running into a burning building, it can be a pretty tough job. Construction worker on the list. Pretty tough job. Have to admit that. Military. Being in the military, tough job. Long hours, right? Lots of work. Number 8 on the list was astronaut. Just ask Katy Perry. She'll tell you. Number 10 was oil worker, right? So yeah. So oil, top 10 jobs. But really, they missed the toughest job. Toughest job in America. Bank guard in Alaska. 50 people in the bank. They're all wearing ski masks. So anyway, easiest job, mortician, right? Everything goes wrong, you get a pulse. So yeah, exactly, no complaints. So anyway. I thought it was interesting though, but firefighter, number one toughest job in America, and we don't pay them near enough, right? The average, so I don't know if this is in every state, but the average salary in Texas, I think, is around $66,000, $67,000 a year. So, but we have clients that were ex-firefighters. They have very good pensions. They have the drop program, other stuff. They do very well, right? They may not get paid a lot while they're on the job, but they do very well with retirement benefits. But anyway, toughest job in America. Speaking of toughest job in America, financial analyst with this market lately. Market's been all over the place. One thing we talked about over the last couple of days is this market's been 9 days straight. We've had this very long extended rally in the markets. 9 days, longest stretch of back-to-back gains each day, right? Consecutive gain days, going back to 2004, so about 21 years. That ended yesterday with a sell-off. Now, one change that we saw yesterday, in particular in the markets, that we'll talk a little bit about more in a minute, is that we saw selling show up late in the afternoon. So we saw buying in the morning, but selling in the afternoons. And that's generally where institutions are starting to rebalance portfolios, do those type of things. So we did see a bit of weakness late in the afternoon yesterday. And so we'll kind of see it. But we got a couple of things coming up this week. We have the Fed meeting that starts today. We'll have the announcement tomorrow. So will they, won't they cut rates? What they're going to say? They're not going to cut rates. But the big question is going to be, what do they say about future rate cuts? Are they still looking at, what's kind of going on in the economy? Are they concerned about tariffs, inflation, those type of things? So again, Jerome Powell's been a bit more hawkish in terms of his outlooks in recent meetings. And of course, the whole debate between the White House and the Federal Reserve certainly puts Jerome Powell a bit on the defensive, because if he acquiesces and cuts rates, it'll look like that he's being politically influenced. So, to maintain that look of independence, he's got to almost be hawkish at this meeting. So we'll see, but that could certainly roil markets here a bit. Markets selling off really probably in anticipation of a bit more of a hawkish stance from the Fed on Wednesday. We'll see. Also, we had ISM indexes yesterday. Services index came a little bit better expected, but we've still got CPI coming up. We've got a lot of inflation data coming up as well. So again, there's going to be a lot of stuff to move this market. And if those readings come in higher than expected, we'll have to see how that works out. But the one thing that's really kind of weighing on markets at the moment, well, I shouldn't say weighing on markets, but weighing on the outlook for the economy has been oil prices, which did tick up yesterday. But again, oil prices very low level. The whole OPEC plus price kind of war that's going on right now continuing to weigh on the oil market. This is disinflationary. This is going to feed through into inflation. So we're probably going to have a little bit weaker inflation readings here in the coming weeks, just because of what's been going on in oil prices, not to mention what's going on in housing prices. Oil is, though, getting very, very oversold here. So again, some reflexive rally in oil would not be a surprise. But again, oil runs on a lag when it comes to the CPI readings. So this move lower in oil prices is going to be reflected in the upcoming CPI index. But here's what you need to know before the bell this morning. Markets did sell off just a smidge yesterday. Again, markets down just a bit. We've had this very, very strong rally, ran right in, close to the 200-day moving average. Sold off a bit there. Markets look to open down a bit this morning as well, about another 0.5% or so this morning. We'll see how the markets kind of play out this morning. Palantir announced earnings last night. Actually, decent earnings. Outlook for AI really strong. The expectation for what's going to be happening, going forward with AI was very strong. The stock's still going to be down about 8% today out of the gate this morning, just because even though they beat earnings and met guidance, forward outlook was good, the stock was just trading at an all-time high. So again, a bit of a pullback there, not surprising. And it's a bit more of a high beta stock, so an 8% decline is pretty normal for that stock. But overall, the market's going to be weak across the board. Diamondback Energy just announced that they say, hey, we're back, and this is something I've not heard since 2008. We're back to peak oil production, according to Diamondback Energy. They're one of the giants in the shale production space. They just announced, had a big headline out talking about peak oil production here in the U.S. And again, this is kind of this amidst this backdrop of very low oil prices. So that suggests that oil prices, if we have reached a peak production in oil in the U.S., that certainly is going to, augur for higher oil prices in the future. But right now, because of where oil prices are, they are now at a below break-even profit. So new wells that have gotten dug recently are not profitable at these levels. So again, this is going to be kind of a challenge for the whole drill, baby, drill narrative. For getting more oil production in the U.S. is low oil prices is not conducive to more drilling. So we'll see how that works out. But back to the markets here real quick. Look for a pullback here. We're not out of the woods just yet. We're still sitting on top of this death cross between the 50 and the 200-day moving average. We did get back above the 50 here. So initial support's going to be 55.50. on the S&P 500. Just below that is going to be the 20-day moving average, which is now starting to slope higher. So that's actually good news on the 20-day moving average, and that gives you support right around 53.70. So somewhere in that range, market's likely going to find some buyers. And as we've talked about before, we've been kind of building this trend of lower, higher lows as we've been riding higher. So again, that's going to run right into this 20-day moving average at 53.70. So again, any pullback potentially is going to work off this overbought condition, and that's going to be really the key here for relative strength. Work off that overbought condition, look for where markets start to try to find the bottom, which should be around 53.70 right now. That's going to change on a daily basis here as markets start to pull back. But again, if we break below that, and then we're going to start looking to challenge these lower levels right around, kind of 51.80-ish at those previous lows. So there is some downside support from here. But again, we've had a very strong rally, so take some profits, rebalance risk, do what you need to do in your portfolio, raise a little bit of cash here. We're going to be in a bit of a slog here for a while as we work through this correction process. But again, this is just one of those things that, we had 2 very, very strong years last year. This kind of, correctional process that we're in right now is not uncommon. It's nothing to really worry about other than we're just going through a correction consolidation process. So we just got to navigate that for right now until we get to the other side of this. And we will, but it'll probably be later this summer before this process is completely over with. So just be aware we've got some work to do between now and then, particularly with kind of the backdrop of slowing economic growth and, of course, the risk of, higher interest rates combined with this whole tariff issue that's going on. So, again, a lot of stuff to navigate here. All right, that's what you need to know before the bell this morning. We'll come back, pick up with John Penn, cover more topics that you need to know about your money right here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, it is John Penn Day. Hi, John.
Morning. How you doing?
Good. So how's things going?
Good. Coffee's good this morning. Need
You
a lot
look
of it.
all chipper?
What's that?
You look all chipper?
I'm chipper.
Yeah.
It's How can you not be chipper at 6:15, 6:18 in the morning? I'm always chipper, man.
It's true. It is true. So you sent me an interesting article this morning. I didn't read. I just read the headline.
Yeah.
And so Brent always comes in the morning and says, "What do you know?" So as soon as I walk in the door, I haven't even sat down yet. I haven't looked at anything yet, right? So I walk in the door and immediately he's on me. He's like that mosquito in Texas, right? As soon as you walk outside, he's been like looming out there for a month. He's like, wham! Exactly. And so, it doesn't give me like 2 seconds to sit down and like look at some headlines. You're like, what do you want to title the show today? And I'm like, well, what does John have? So he says, there's no free lunch. And so I said, okay, fine, go with that. And so I didn't even read what the article was about. What you're talking about fees, I was talking about no free lunch in terms of market dynamics, right?
Well, you can do that too. You tie it all together if you want.
I absolutely can.
You mean you don't think about the show when you're driving in?
I don't think about anything when I'm driving. Generally,
except driving.
I honestly, I don't even think about driving. I'm like one of those people where I show up someplace and go, how did I get here?
Oh, no.
I'm like on autopilot. My brain's just off.
We need to get you a self-driving Tesla, I guess. No?
No.
Just waiting for that response. I was waiting. I teed that one up.
Look, I drive a 2019 fully paid for Toyota 4Runner.
Yeah.
And that thing, I've got 50,000 miles on it. And when it gets to 400,000 miles, I may think about tuning it up. So,
you probably just drop a new engine in it. You may not even need a new engine in it at that point. That's still brand new.
Exactly.
Uh-huh.
Not even broke in.
Exactly.
Not even broke in.
Brent's still driving a 1939 Mazda.
Hey, now.
It's got the crank on the front. You gotta.
It's got the crank behind the wheel.
Yes, exactly. Cranky. Anyway, but no, talking about no free lunch. So that was funny because I didn't really read your subject. I just took the headline with it, and
makes me feel good. Thanks.
Well, generally, the stuff you bring to the show is not really that strong, so I've got to work with it. I'm just teasing.
Here we go, folks.
I know it's a Tuesday. But yeah, so when it comes to investing, we often say there's no free lunch, and what that means is there are some certain things that people kind of take as givens. Is that when markets are do this or they do that, this is going to be an absolute outcome, and that's normally the case. Statistically speaking, I was talking about this yesterday. Is that when you have these very sharp rallies like these 9-day gains, everybody goes, oh, look, in the next 12 months, markets are always higher. So it's a free lunch. That's not the case. It's that there's a lot of volatility that can occur between now and 12 months from now. And yes, the markets may end up higher. The question is whether or not you can survive that, getting to that point. And again, so you've got to be careful with these axioms and statements that are made by the financial media that, just if you do this, you've got a guaranteed outcome, because you don't. And there is no guarantee of anything that is going to happen in the markets. And what gets us as investors is usually the unexpected, right? We talk about these exogenous events that occur that nobody was thinking about. And, we saw it with the pandemic. We just saw it recently with Liberation Day. Nobody was expecting President Trump to come out with the tariffs that he came out with. Everybody was expecting 10% tariffs, and it was going to be a tit for tat tariff thing, right? You tariff our cars, we're going to tariff your cars, those type of deals. But when he came out with tariffing penguins on McDonald Island, that was a whole different ball game the markets weren't expecting, and that's what caused this big sell-off in the market. So it's these unexpected events that can really ruin the idea of a free lunch.
Yeah, I think the more folks I visit with, everybody's trying to figure out what does the future hold, right? And especially when it comes to putting their money to work, there are ways where we can guarantee a return. There are ways where we can predict what your return will be. If you invest in a portfolio of bonds, for example, and if you've got coupons, you've got when these bonds are going to mature, if you hold them to maturity, they're going to mature at par. So if we invest in a 100% fixed income portfolio, I can give you a pretty good idea about what your future returns are going to look like.
No, that's a false statement.
Okay.
Not a pretty good idea. This is the one thing that people don't understand about investing in bonds. I can give you a guarantee of exactly to the 100th of a cent.
To the point.
of what you're going to make in 5 years, 10 years, whatever it is. This is the beautiful thing about bonds. Now, people worry about the volatility in between, right? Prices go up, prices come down, just like anything else. But the beautiful thing about a bond portfolio, and especially when you're talking about treasuries, because it's the only quote unquote risk-free investment, is that you, to the penny, you can know what your return is. It's not kind of sort of maybe around, it's not an average, like we do with stock markets. It's to the penny, this is exactly what you're going to make.
Yeah, same with an annuity.
Yeah.
Right. You put your money into an annuity, like if it's a like a single premium immediate annuity, you fund it, you turn on that cash flow, right then and there what your payments are going to be for the rest of your life. Right. So a lot of the questions that I get too is, well, if we look at putting a portfolio together where we're managing stocks and bonds and cash, kind of in a more of an actively managed portfolio. So sometimes the questions I get, well, if we start investing, January 1st, what will the portfolio be worth, a year or two from now? And there's not a way to predict what that outcome will look like, right? But if
you can make assumptions.
You can make assumptions. Yeah. You can make assumptions. But so going back to that no free lunch, so sometimes going back to the bond portfolio, okay, to the penny, here's what your return is going to be. Sometimes the response is, well, I don't know if is that enough.
But there's
I want more.
Well, right, but there's the greed factor.
There it is. Well, I don't know, 4%, 4.5%. I don't know, John. Is there a way I can get more?
Yeah.
Well, yeah, possibly.
And this is the funniest thing about people when it comes to markets.
Yeah.
In 2022, we had people doing T-bill and chill.
Oh yeah.
Because I'm completely happy if the market's going down. If I can just make 5% of my money, I'm great. I don't need to worry about any of that. Next year, the market's up 20. They're trying to figure out how to sell the bonds to go get into stocks, right? Last year, it was the same way. Market's up 20, and now they're all trying to sell their bonds to get into stocks, right? But what happened with you were fine with 5%?
Yeah,
you were fine with 5% when markets are going down, but now you want more. And this always goes back to the biggest mistake we make as investors is allowing greed to overtake what our goals are.
That and what I like to call hindsight bias is and looking in the rearview mirror and just saying, well, if I would have just done this, or if I would have just invested here, or I would have been better off doing this. Well, yeah, looking back in the rearview mirror, you're right, but those events have already happened, so it's easy to look back and go, well, I would have been better off doing this, or I would have been better off doing this. So it all really kind of comes down to, again, what is your tolerance for risk, and what sort of return do you really need from your portfolio to support your lifestyle moving forward? Maybe it is 5%, and maybe 5%. But if it is, and if you're like, well, I'm going to lock in this 5%, I'm going to be happy with it, then that's the decision that you need to make. You can't say, well, markets are up 20% this year, so gee whiz, John, we should have done that instead, right?
And the comments in the chat right now saying my dog got a free lunch. No, my dogs did not get a free lunch. They don't get lunch. They get breakfast and dinner. That's all they get. So, no, they don't
get any treats during the day?
Very few.
Okay, so there's some.
Well, but they have to do labor. Like they have to take me this morning. They had to take out the trash. So now that involves me taking out the trash, and they go out with me. But
they're guarding you.
Yeah,
they're protecting you.
So
that's right.
They have to do some work for treats. Mm-hmm. So yes, I want their job. My daughter in college. So I have one son who lives overseas, and so I have two in college and my son in college. And it was interesting because now they're starting to get close to graduating, and she's gotten now a full-time job. She got to where she wanted, and she's about to graduate, but she's also working full-time at the same time.
Congratulations, that's awesome.
Yeah, so she got a kind of a good slot. And she's like, man, this working every day, it kind of sucks. I go, yeah, it was the first 18 years of your life were great because everything was paid for. Your clothes were washed, for you, blah, blah, blah. House was clean for you. Didn't have to worry about it. Now you got to do all that yourself.
Yeah. Hey, what's for dinner tonight, Dad?
Yeah.
What are you cooking tonight? Why does it matter? Did you pay for it? No. Oh, good. Well, then I guess you'll like what we make, won't you?
That's what she was saying. She goes, the biggest thing that sucks about being an adult is I have to decide what I have to eat every night. Then I have to cook it. I'm like, yeah. So yeah, I always told them, I said, don't rush growing up. This is the best part of your life where you just get to kind of do anything you want, go anywhere you want, have everything taken care of for you. You don't have to worry about anything. And, you complain about being in school. I know it's a drag being in school, but trust me, you'll be missing this. And it doesn't take long.
Let's sit down and talk a little bit about auto insurance and your premiums. And let's talk a little bit about rent.
I have a problem right now with my son.
Uh-oh, what's going on?
He got a ticket yesterday. I've been on him now for a while, and I always check with him and say, hey, got your car inspected? Did you go do, get your oil changes, those type of things, make sure he's taking care of his car. Apparently, I forgot to ask him about his registration.
Uh-oh.
So he got to get a ticket. Car has not been registered for 3 years. It's now fallen out of the system. Somehow I missed him. I got it done with my daughters. I made sure that theirs was done. Somehow I missed him, and so my bad for not.
He's not feeling any love right now, huh?
No. I was like, hey, this is on you. You're gonna have to figure it out, But forgot to tell him you had to register the car. So my bad. Anyway, all right. Growing up. Anyway, all right. We'll come back. More with John Penn. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Talk about, why do you own gold? Why own gold? Because if everything collapses, it won't matter anyway. You're not going to survive more than 7 days. I don't care if you've got gold or not.
The Real Investment Show podcast.
You don't know how to go out and forage for food. You don't know how to go out and hunt. You've been sitting around your house watching television with your feet propped up, drinking beer for 12 years.
Same show, your schedule.
Danny Ratliff is one. He's going to survive just fine. He's in South Africa right now. He's out there with a knife and Rambo paint on and stalking predatory animals. He'll survive just fine. My next door neighbor with the drill, he ain't gonna make it. No chance.
At realinvestmentadvice.com.
If economic Armageddon happens, pack it up, buddy. You're done.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows, Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So an interesting comment in chat talking about AI, and one of the things that is a concern for every job is whether or not AI is going to replace your job, and the answer is yes. It doesn't matter what job you're in, AI is going to, and this is going to be one of the great debates going forward. I was reading an article just recently like AI is going to increase GDP per capita, and that is a very, very bad analysis, because what that says is that I can increase GDP through AI, right? I can increase productivity, I can increase profitability, I can increase economic prosperity through AI. And then you just divide that prosperity by all the people in the population, and that assumes that everybody is participating equally. That is not going to be the case. Yes, GDP per capita may raise because of AI, but it will be highly concentrated to those that are basically using AI to generate profitability versus everybody else. And one of the big concerns is going to be ultimately, where is going to be your position in the world when AI becomes much more embedded into the overall economy, right? Kind of what jobs are needed, what jobs are not needed. How many people are needed to do a specific job, and whether it's being an accountant or a lawyer or whatever it is, right? I mean, think about just an example, say a lawyer. How many law firms have lawyers, and then they have paralegals and assistants and researchers and all this other stuff? But now all of a sudden, with AI, I don't need all the researchers anymore. I don't need the paralegals. I just tell AI to write my brief, whatever it is. I put in the inputs. It spits out my briefs. So, one of the big challenges for AI is going to be job elimination. And it's going to be differentiating your position in the world for what AI maybe can or cannot do. And one of the questions in chat was, will it replace financial advisors? Yes, absolutely. There will be no need for financial advisors in the future. Now, John's going to argue with me.
Disagree.
I know. I'm setting you up here, so you can disagree.
I disagree.
Because John says that there's always going to be the need for the human component. I don't like people.
Look,
if I can get away with not meeting somebody to do something, I'm definitely going to take advantage of AI.
So for all of us who like to communicate and associate with other living beings.
That ain't me. I'm going to be out there with Danny hunting Cape buffalo. Living off the land.
Well, the two of you will still have to talk.
No, he's going to be on his own terrain over there. We'll just be we'll just be kindred spirits.
Get you some good walkie-talkies.
Exactly.
Remember those?
Exactly.
Yeah.
If I need you, I'll call you.
That's it. If I need you, I'll reach out to you. But no, and this is, there's been a lot of great articles out around AI and the future of AI and how does that incorporate into the financial advisory space. And AI is already here. I mean, just to help with efficiency, notes and schedules, and to kind of free up time so you can spend more time with clients to get to the good stuff, the planning and all the analysis that we do. But I personally think that the role, like this role, being in the financial advisory space, no matter, this is just my personal opinion.
No, I agree. I'm just messing with
I know you are. I think there's always going to be a need to a certain degree for some human connection, especially on the emotional side of things when it comes to markets and money and emotions. Or my goodness, how many folks do we work with where they've lost a loved one or their significant other, and that significant other kind of took care of everything for them, and now they're kind of left trying to figure this all out. There's something about being able to sit across the table, look somebody in the eye, shake a hand, give somebody a hug to say, hey, we got you.
Yeah.
And we're going to take a look at this.
And more importantly, and as you and I are well aware, is like for instance, just recently after Liberation Day, you and I were having an email conversation back and forth about a gentleman.
Yes.
Right. Markets are crashing, and right after Liberation Day, and he's panicking because of what's going on. And it's like, hey, just relax. It's going to be fine. And AI is not going to do that for you. AI isn't going to provide that human touch. Now, my job will go away entirely because, in fact, in SimpleVisor right now, we're very close to launching a whole series of AI components where you can plug in a stock and it will give you complete analysis on a stock with 10 different agents based on Phil Fisher, Ben Graham, Warren Buffett, all these type of guys. It'll give you basically a rating on the stock based on their analysis and their synopsis of that, all AI driven, right? So my job as a portfolio manager will go away.
I see. I kind of disagree there too, because you got to be. So I think.
No, you just can't. No, I'm telling you this. You can disagree with me.
All right.
I cannot think as fast as AI. Right. So when it comes to analysis and stock picks and those type of things, and plugging things into portfolios and construction, AI can do that way faster than I can.
Yeah.
And so but it's a different environment.
Yeah. But so. You need to be behind the AI.
Of course.
I
got to program it.
You got to program it and give it the parameters, right? So it's not really. But
then I'll retire.
Replace you. Oh, you're not. See, this is where it's going. He wants to retire. This is where the conversation's going.
That Sunday is my birthday, right? Monday is my birthday.
Next week?
That's coming Monday. Yeah.
Well, happy birthday early.
Yeah, no, but
what are you wanting, like a retirement birthday? Is that what you're hinting at? You want a retirement birthday
party?
Oh, yeah, that's not going to happen.
I know Danny keeps telling me my plan doesn't work, but
no.
Yeah.
Yours is locked in a vault. You can't retina scan it. You can't get into it. This is where the conversation's going around AI. He wants to retire.
Exactly.
No, but I going back to, does AI have a place? Absolutely.
Yeah,
but I think I still don't see it being like replacing.
Well, no,
but it can definitely allows you to be even more efficient with your time than you already are.
It does.
Yeah.
But this goes back to my original conversation, though, which is original part of the statement is that's what people are going to have to figure out is how to be that part of AI that is not replaceable. Right, that human connection, because there'll be a tremendous amount of jobs, and this goes back to my whole fallacy about GDP per capita. When you measure stuff, GDP per capita is a fine way to measure things. If I just want to measure GDP per capita of the U.S. versus the UK as an example, great, but that doesn't solve the issue that the top 10% of income earners in the U.S. have 90% of the assets. Right. So if you really look at GDP per capita, it's owned by the top 10% of the population, not the bottom 90. But that and that's going to be the same thing with AI. AI is going to replace a lot of jobs because those will no longer be required because AI can do that more efficiently and more cheaply. I don't have to pay it benefits. I don't have to supply 401k plans. I don't have to worry about sick leave and parental leave and maternal leave and all these type of things. With AI, it just shows up 24 hours a day, 7 days a week, and does its job.
Reliable. Yeah.
Yeah. Mm-hmm. So that's going to be the big challenge, and this is one thing I just try to drill into my kids, constantly, which is, I don't care what you do for a living, just realize that this is on your heels, and it's going to change your future. And it's interesting, all these people that are, making a living being influencers on the internet, right? The future of that is interesting only because you can now create entire videos all by AI with no human being to sell products. So I don't really need a person to pay to advertise my product when, as a company, I could build AI agents to create a YouTube channel and do a more. If I write the script, you wouldn't even know it wasn't me, other than it would be missing the bad jokes. But
see, there are things that AI just can't replace.
Yeah, the jokes. I wanted to. I'm waiting for Danny so I can tell Danny my seagull joke. Anyway,
and how do we really know that it's you?
Because of the bad jokes.
Oh.
Because honestly, you just can't. You can't program that in.
I don't know.
This is true. But those are things I tell my kids that you're going to have to figure out a way to differentiate yourself, because if you don't, AI is going to take your job.
Yeah, it's there are friends of mine who are attorneys in different specialties, and they've said that the whole ChatGPT AI movement has completely changed their careers.
Yeah.
And how they, research and look for information. And there's, for that younger generation that wants to perhaps get into that profession of being an attorney, it's a real challenge in that space right now, at least from what I'm hearing from folks who are directly in that space.
Yeah. Well, I was just reading an article yesterday. Big law firms, starting first year lawyers making around $250,000 to start, $250,000 a year. That's not bad.
Yeah.
Right. But the question is if I'm the owner of the law firm, how much can I start shaving off those salaries in the future to increase profitability of the law firm?
Yeah.
Right. Mm-hmm. And this is going to be the whole thing. It's just, and again, this goes back to, it's talked about a lot that AI is going to increase productivity. This will be great because people have more time to do stuff, and it'll be more efficient. You'll have a lot more time for leisure and entertainment and all these type of things. But that may not be. Yeah, you may have a lot of free time for leisure because you're not working. And that's going to be the real challenge. So, this whole AI prosperity thing, I think there's a dark side that we're not potentially paying attention to, just trying to think down the road. Right?
Yeah, it's kind of like unintended consequences a little bit, right? I mean, it sounds great from an organizational standpoint, time, efficiency, maybe reduce cost, et cetera. But, what are those possible unintended consequences that we're not thinking about right now, right?
I mean, and we talk about this, right? We used to have receptionists for businesses, and they've all been replaced by answering services now, right? Press 1 for English, press 2 for Spanish, and press 3 for this department. Call your bank. See how that goes for you. But we eliminated a whole job set with automated answering services. And you can almost kind of see that coming with AI as to what jobs are just going to just no longer be here because you just don't need them anymore. All right, you're right back. Wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
and welcome back to the show this morning. So we're just talking a little bit about AI and just, kind of the impacts on the financial advisory business. And, it is going to be interesting. And again, we're doing a lot to incorporate AI into SimpleVisor now. So we got some really neat tools that are coming out for that. But again, that's just going to, be the evolution of investment research. And, it used to be the day that Wall Street was where you went to get investment research. Now there's just tool after tool after tool. You can do it on your own. You just have to spend the time to learn how to do it and put the effort in. If you're going to trade your own money, I don't understand why you're not doing your own research. But, there's plenty of tools out there to help you manage money better. And again, if you haven't checked out SimpleVisor, I encourage you to do it. A lot of tools there. Basically, we took all the tools that we use to manage portfolios and we built a website around it for you. So you can go check it out. It's free for 30 days. So just go check it out, simplevisor.com. Wanted to shift gears here real quick, talk about target date mutual funds. These are the worst things on the planet. And I see more and more people that, especially when you see people's 401k plans, like they have all their money in a target date mutual fund. And, a lot of these are now automatic allocations where if you don't pick a fund allocation in your 401k, companies are now automatically enrolling you into it. And so you immediately get enrolled and they start making a contribution for you. And if you don't make selections, you just get slapped into a target date mutual fund. And if you don't understand what a target date mutual fund is that it's designed, supposedly, that as you start to approach the date of the fund, it gets less risky, right? So you pick a target date 2050 fund as an example. It's supposed to be that right now it is mostly equities and a little bit of fixed income. But as you get closer to 2050, it's increasing the fixed income allocation and reducing the equity risk. But that's not really the way that it's working out.
Yeah, you look at a lot of target dated funds, like a target 2025. So let's say you're retiring this year in 2025.
Right.
I think folks are a little surprised to see that a lot of target dated funds that are dated for 2025 still have an allocation to equities in general somewhere in that 50 to 55% range, right? And I'm not saying that that's bad. I'm not. But I think sometimes folks they're just a little surprised where they go, well, I'm going to retire this year. I want to set up my portfolio to be a lot more conservative. And when they take a deeper dive at that target dated fund, there's still over half of the roughly half or a little bit more of the portfolio invested in equities, right? And it's not just, and it's large cap stocks. There's usually a pretty hefty allocation to smaller company stocks in there too, as well as the international side. So this year, especially with an allocation to the small cap side, small caps have been beaten up pretty hard this year, right? So it's just about I'm not a big fan of these target dated funds.
And you need to understand what you own.
That's it. You need to understand what you own. So, you sign up for your 401k plan or your Roth 401k plan, and you don't make a selection. It's there. So target dated funds are really there to help kind of more of the beginning investor or the novice. You kind of get their money invested. But if you don't make a choice, your retirement plan is going to choose one for you. Right.
Well, and again, I think it's a little bit of a misnomer too, because when target dated mutual funds first came out, it was kind of pitched this idea is that, it's going to make sure that when you retire on that date, your money's there for you, right? And it doesn't terminate. I can still buy a 2020 fund.
Oh, sure.
Right? Or 2010 fund. Those funds are still out there. So they don't terminate. And again, I think from the marketing perspective, the way it's a target date fund. Okay, that means when I retire on that year, this thing is going to terminate and give me all of my money back. And that's not the way those funds work. Now, there's bullet funds that actually do that, right? So you can buy a bullet fund that says, okay, it's going to mature on this date, and it matures and goes to cash. That's different. But these target date mutual funds are kind of mismarketed in a way.
Yeah.
Because it's like, oh, this target date, and again, it's assumptions that people make, right? It's like on this date, this thing is going to have all my money here. And then again, when you reach that date, if the market's in the middle of a drawdown and you're, retired, so let's just assume it's next year, right? We're in the middle of a recession next year. The markets are down 30%, and now you're retiring and 55% of your money's in stocks.
Right.
And that's the risk you run. And so this is why it's important to understand what that target date fund is in, and how you're allocated, and more importantly, where you're allocated.
Right. So, and something else to really pay attention to with these. So every mutual fund, right? So kind of going back to that no free lunch, but there's an embedded internal operating expense within the fund. That's how the fund makes its money, right? You just, as a mutual fund investor, when you're investing in a target dated fund, you typically don't quote unquote see the fee. It just comes out of your return, right? So maybe the fund has an internal operating expense of 1%. Maybe the fund's up 10%, but then your net return is 9%, right? So, but you don't see the charge, you don't see the fee. What you have to be careful with these target dated funds is that they're usually built, it's a fund of funds, right? So there's a number of different mutual funds within the target dated fund structure, and sometimes the target fund itself will have a fee, but then those underlying mutual funds in there also have a fee. So all of a sudden now maybe you're paying kind of 2 layers of fees within that target dated fund. They are not all that way. Some they don't charge at the fund level. Some do. That's why every target dated fund is different. You gotta peel it back and take a look at how it's structured and what are the fees that you're paying with these as well.
Yeah, and just for me personally, I'm not a big fan of target date funds.
Yeah,
because in most 401k plans, and look, I know there's people that buy target date funds outside of 401k plans too, but in 401k plans, you generally have other options. You'll have an S&P index fund, you'll have a bond fund, you'll have, mid cap funds, small cap funds, et cetera. And then you'll have this whole long list of target date funds. I think you're better off to build your own allocation. And so that you understand what you own, right? So I want an allocation that's, 50% stocks and 50% bonds. And I want my 50% stocks divided this way, mid cap, small cap, international, emerging markets, whatever. But at least you understand what your allocation is. And so when you become more risk averse and as you're approaching, your retirement age, whatever it is, you can manage that exposure. You can reduce your exposure to stocks, increase your exposure to bonds, vice versa, whatever you want to do. But I think you just have more control over the allocation if you'll spend a few minutes with your 401k plan and build that allocation yourself.
Yeah, and target dated funds, they are popular. I mean, as of the end of 2024, they're easy. It's they're kind of marketed as a set it and forget it, right? But I think the misnomer is that folks think that a target dated fund, is going to be actively managed. It's just more of a shift of risk. They're designed to become more conservative as you get closer to that target date. They're not. I don't really consider that active management as far as equity to bond exposure, depending upon what type of market we're in or the type of market we might be getting into. But as of the end of last year, 2024, there was $4 trillion in target dated funds. And Morningstar had a really great report about these, where the overall the exposure to equities, the equity exposure in target dated funds is higher than what it was about a decade ago. So about 10 years ago, when folks were getting started with a target dated fund, maybe you're younger, maybe it's a 20-55 fund. Your initial exposure to equities was roughly about 85%. Now today, there's an initially higher amount of equity exposure in there, roughly 90 to 92%. And so Morningstar was saying, well, it could be that because maybe
growth of markets.
Yeah, and longevity, folks are living longer, so maybe the target dated funds feel like they need to add a higher amount of equity exposure just to help protect the investor from a longevity standpoint. Or could it be that if bonds haven't been as exciting, does it make sense to add more stocks to the portfolio?
Or is it just the function that stocks are growing? Yeah, right.
True.
And over the last 10 years, they've had 12% a year returns versus the normalized 6 to 8% rate of return.
Right.
They've just outgrown their weightings.
Yeah.
But they're not going in and rebalancing on a regular basis.
That's right. And you look at a year like this, so sometimes folks can kind of downplay bonds. Well, look at this year where, for the year so far, the S&P is negative and bonds are positive. Yep. So having more bonds in the portfolio this year it's helpful.
Yeah.
Right.
And by the way, that brings up a really great point. If you just assume the average, kind of allocation across all, $4 trillion in target date funds is, say, 60% stocks and 40% bonds. So, everybody's all worried about, if China sells their bonds, or if Japan sells their bonds, it's going to cause all these problems with interest rates. Target date funds alone have about $2 trillion worth of bonds. Yeah. And that they own as much bonds in target date funds that China and Japan have together collectively. So, again, there's, everybody always kind of forgets that there's huge buyers of bonds in the U.S. just through target date funds, pension funds, mutual funds, et cetera.
Money market funds. Oh my goodness.
Mike and I were talking about that last week. Is everybody's all worried this year about the $9 trillion of debt we have to refinance, which is all short-term bills, and money markets will line up to buy new bills because they've got to replace the ones that are rolling off the money market funds.
Yeah, because you have to think about it. If you're earning, let's say, 4% from your money market fund right now, the custodian where your money market, they're not just paying you 4% because they want to. I mean, they're managing ultra short-term paper in there that's generating those rates of return, and they're typically short-term government paper.
That's right. Yep, repos.
Yeah,
short-term paper. They're taking a spread off what they charge versus what they pay you.
Yeah, there's an internal operating expense with your money market as well. You just don't see it. The interest that you receive is your net return.
Exactly. All right. That wraps up the show for today. Be back tomorrow with Danny Ratliff, the Great White Hunter. And then on Thursday, we'll have Michael Leibowitz to discuss the Fed decision tomorrow. So we got a lot of stuff to go through the rest of this week. So we'll see you then. Be sure to like and subscribe to the channel. Appreciate it very much. Keeps us on the air for you. And, of course, we'll see you back here tomorrow. Get by the website, realinvestmentadvice.com. Latest blog posts are out. Have a great day.